Greetings, Dr. Jeffrey Scott here. This is my weekend market update for the week with ending in Sunday, July 28th, 2024. I titled this week Mr. Market's Wild Ride, thinking back to, I think it was called Mr. Toad's Wild Ride movie from when my kids were growing up. And this was a wild ride in the market. Hard to say anything but that. My email address is hgsidoc@gmail.com. You can email me. I'm happy to respond to constructive criticism, questions, comments. Or you could put something in the remarks on YouTube. If you're new to my channel, click the subscribe button, and if you hit the alarm, you'll get notified when I play something. I do these as my time allows. I've been doing them every weekend unless I'm traveling or having surgery, which was the recent time. But I've been doing it for 20 years plus, and I hope you find it valuable insight as you start to think about how you manage your positions and look at the market. Disclaimer, this is for educational purposes only. Anything I recommend should be taken in the spirit of education and not investment advice. I'm a doctor, not a broker. I am independent. I pay for the tools that I use. And trading involves risk, and you alone are solely responsible for any investment decisions you make. I don't know what your account size is, what your risk tolerance is, and what your goals are, so I couldn't really tell you what to do if I wanted to, and I don't have any of the licenses that would allow me to recommend specific trading instruments. If you like these videos and you want something during the week, I try and post at stocksanddocs.com as often as I can. When you go to the site, you'll ask you for your email address. I don't get it, so I won't be bothering you, but it will send you an email every morning that I post it so you can see for yourself what I'm doing. I always like to start to look at the major markets. Now, for a while, the equal weights were doing very different than the cap weighted, and we saw that again this week where the RSP was up for the week up 0.4 or 0.8 for the last 5 days. We'll use that one versus the spider, which was down 0.8. So a difference between the two. And if you look at the equal weight, NASDAQ down minus 1.7 for the Qs versus minus 2.6 on the week for the QQQs, or for the 5 days. So we continue to see outperformance of the equal weight over the cap weight as this market has continued to rotate. Leadership is now the Russell. So a couple things. Russell was up over 3% on the week. The NYSE was up a little bit less than 1%. And the Dow, which really had a wild ride, was up 0.7%. And then the cap-weighted spiders were down 0.8. The NASDAQ composite was down 1.8. And the Qs were down 2.60. So we continue to have weakness, especially in the mega cap tech space. Now, notice if you look at year to date, all right, we're in July, so this is the end of July. So for almost 8 months performance, the Russell, which has been a laggard from the beginning of the year, 11.7, is just behind the S&P at 14.5, and the NASDAQ composite at 15.6, and the Qs at 13.10. So 2 weeks of massive rotation, and all of a sudden what we were seeing as a skinny, narrow market with leadership in a few tech names, the Mag 7, not so skinny anymore. Is that good or bad? We're going to find that out. If we look at the sectors on the week, materials led, up 1.4, financials 1.3. You could see utilities, healthcare, all over the last 5 days or from the beginning of the week were the leadership groups. Discretionary tech and communication were the underperformers. And it's interesting because during the first part of this year, that's where the leadership was. This is Sagar Nandi SuperiorProfit.co, C-O, not C-O-M. This is his Q Edge tool, which is one of my favorite tools to assess market breadth. And it tells me on Friday all the sectors in the S&P 1500 were up, 94% of the industry groups were up, and 88% of the stocks were up. That's a pretty bullish looking day. 78% of the stocks in the S&P 1500 above their midline is bullish. You could see here all the S&P 1500 sectors were up on the session. Now, why is that different than the prior chart? Because the prior chart was looking at the S&P 500, and as we talked about this market broadening out its leadership, it's not a surprise that a broader index may have more favorable results. Down here you could see we have had some major healing in the market, and despite the fact we had some pretty wickedly negative days, at least looking at the S&P 1500, over a month almost all the sectors are up, 3/4 or more of the industry groups are up, and in the 70 to 80% of the stocks are up. So even though there have been some high profile blowups and weakness in the market, overall the larger market seems to be intact, the larger um, indexes. If we look at the Q market breadth tool, which is another Sagar SuperiorProfit.co tool, you could see we had a green too. So we had 2 days, two indexes gave us accumulation on Friday. You can see that the last bango on this combined NASDAQ and NYSE synthetic index goes back about 2 weeks. You could see improvement in the breadth of the stocks above the 50, stocks above the 200, AD lines, up down volume, and new highs all improved um, on this week, especially at the end of the week. You could see in this light blue that small caps are outperforming large caps, and that here values actually outperforming growth. Now, the next slide looks at the NASDAQ and the NYSE. You can see that accumulation dot. And one concern here is this 13-week new high low. This blue line, which I'll come to a couple times in this session, is approaching this overbought area. The last time, and almost every time it gets there, it reverses. If we look at the major indexes, you can see, for example, the Dow is 13-week new high, new lows is almost 100%, which is typically a sign that we reverse. But this is such a skinny index, I don't pay much attention to it. But the Russell 2000 is now showing the same overbought signal. So we have to be a little bit nervous, and here's that other sign of accumulation, the one on the Dow Jones. If we look at the Nick Drendel tool, good things and bad things. All the major growth industry groups were actually up on Friday, but over 5 days you could see some big losers. Crypto down 3.8, semis down 3.2, consumer discretionary down 2.8, and at 5.2, defense and aerospace was the big winner, followed by biotechnology, so turnarounds. This gives me a sense real time of what's working, what's not working in the market, and I find this tool to be very useful for me as I try and figure out what's going on in the market at a given time. Notice the new high, new lows are green, and if you look at that 13-week or 3-month, these numbers are pretty significant. So the market has definitely improved, and the new high, new lows are reflecting that. Rates were mixed. Well, what happened on Friday was pretty cool. We had a very, very positive PCE on Friday. And, well, positive meaning it didn't scare anybody. Now, the markets were down, yes, at least the spider was down, and you could see here that the 10-year rates were down a bit, but the 30-year rates were up, kind of flat. Is there a recession in our near future? I'm hearing more and more conversation about that in the markets, and I think it's a valid question, a fair question. Um, Notice up on top, this is the 10 minus 3-month yield curve and the 10 minus 2-year yield curve. And the black line is the zero line. We've been inverted for quite some time. You probably have to go back to the 80s to see this length of time. Notice this gray bar, which is a recession, which occurs after the yield curve corrects pretty much every time. So we're going to correct, and you know, I suspect there's a fair chance that when that happens, we could have some type of a recession. Hopefully, it will be a shallow one. If I had to guess, it's nowhere around the corner. And if I had to guess, I'd be wondering if it's more likely to occur after the inauguration of the next president. Notice here the yield curve is getting close. It's done that before and we'll be watching closely. But again, when do we get the recessions? When we cross that black line. Is there credit tightness? No evidence of that here. And the economic activity is still positive, which also goes against a recession. So I think the yield curve is the key to me, but I don't think it says it's coming imminently. Now, the Fed's going to have to deal with timing, and there's still very little expectation that the Fed meeting this week will result in a rate cut, but there are a lot of people expecting the Fed to act in September. Could we get a surprise and the Fed wants to front end and prevent a rotation and help ensure a soft landing? I'm sure there's many market participants that would like that, but personally, if the Fed cut this week at their meeting, I'd be wondering what they know that we don't know. Now, breadth, if you look at stocks above the 200, stocks above the 40, increased significantly this week. And if we look at that 13-week new high, new low, those that follow me for any length of time know that that's one of my favorites. And when we start to get close to this line, we get to an area of frequent reversal. And, you know, we're kind of getting close to that line, but we're not close enough that I would say something is imminent. I thought this was interesting. The AD lines for each of these indexes are in yellow. The NYSE, the AD line is running straight up and leading price. The NASDAQ, I think they're both turning up, so I'm not going to say much. Look at the Russell, the 1000, the large cap. Look at the AD line going straight up while the index is heading down. And then even on the NASDAQ composite, the index seems to be rolling over, yet the AD line is going up. The Russell 2000, the leader, they're going lock, stop, and barrel. They're both going up. To me, that's a nice sign when I see the AD lines are actually turning up. And will these lead to higher highs on the indexes? Current buckets. So I love the idea that you could take the Bollinger Bands and rank them from 0 to 100 and break them into 10 deciles and then look at how many stocks are in each of those 10 deciles and then how many are above or below. Why above and below? Because 90% of the time the stocks are supposed to stay in those 10 deciles. So if you're above or below, that only occurs 10% of the time combined. And if a lot of the market is above or below, it probably tells you you're getting to a point of an imminent reversal. So as I mentioned, 78% are above the midline. We're about 10% above, hardly any below. No signal there. That's a bullish picture. If you back up to the 16th, just 10 calendar days ago, you could see we got to 91%, which was too high, and 60% above, which was the most overbought by this metric going back to the 1990s. The opposite occurred on April 16th, which was probably a major low, and you could see that over 30% of the stocks in the S&P 1500 were actually below their Bollinger Bands, and again 91% below the midline. Now, why is this important to me? Because it works. That if you look at any major market run, bottoms are made, with a lot of stocks below the buckets and the pie chart mostly red. Tops are made when you have lots of stocks above and a very high number in the pie chart of green. So I follow it. I would say we're neutral to bullish. The Hindenburg omen, which is a signal that I like, learned from my mentor Ian Woodward, and I follow it continuously. Well, it fired, it was confirmed, and we've had little sell-offs over the last couple of weeks. But right now, I'm looking at the other numbers here, which is in green on the NASDAQ 8% new highs, 1% new lows. On the NYSE, all 12.5% new highs, 0.29 new lows. And on the NYSE Commons, 13% new highs, 0.34% new lows. Is that at a key reversal area? No, but it tells me we're getting a little ripe to the upside. So what did we see this week? This is another tool I use. It's called Edge Rater. Takes all the stocks in my trading universe, which is $2.5 and 250,000 shares, and looks at performance on the top versus ERG. What is ERG? EPS rank plus relative strength plus group rank. The bigger the ERG, that is a growth stock metric. I don't include the last couple of data points in the first because the number of stocks are small, but it's pretty clear that you had outperformance to the left, which is in the junk off the bottom side or market rotating. In fact, if you looked at stocks with no earnings versus big earnings per share rank, the low earnings per share rank outperformed, as did the low relative strength. So that's just a tool, objective, using math, that shows we have market rotation. So we had a broad rally, almost everything's above zero, despite big cap weakness, rotation, and lagging growth. At my June live meeting in Orange County, we came up with a list of leaders. We knew the market was getting frothy, and we said that if that leaders group breaks down, that should tell us the market's going to break down. It's on life support here. It is sitting on the 50, and pretty much when it broke down below the 17, that was a bad sign. But we know that great leaders or indexes of great leaders, as they did here, can, as part of a consolidation, small pullback, pull back to the 50 and still run. So they're not dead yet, but they're kind of getting close to needing some CPR. Know your news and earnings. FOMC on Wednesday with a Powell press conference. We got some jolts, consumer confidence, Case-Shiller Home Index on Tuesday, 80 employment cost on Wednesday, jobless and productivity on Thursday, some manufacturing numbers, and then the monthly employment data on Friday. So there's plenty of news for you this week. And by the way, in case you weren't paying attention, and I know you were, there's a lot of earnings as well, and especially some things like AMD, which is sold off hard, Microsoft, Meta, ARM, Apple, Intel, Amazon, and some big oil. So it'll be very interesting to see. And as I have put in the lower right-hand corner, it is a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So a lot of thoughts up top. Talk about the S&P and the NASDAQ lagging. I showed you that. Big profit taking in the mega cap and semiconductor space. Semiconductors were down 3.1. Mega cap growth ETF down 2.8%. We talked about which sectors declined. Markets continue the massive rotation as secondary stocks rotate into the lead while the Mag 7 continue to be sold. It is a tough market. Think about Thursday. It looked like, whoa, what a great day. And then we had a big reversal and closed kind of where we opened. And then Friday we had the PCE and the markets were having a wild ride up again. Hence why I called it Mr. Market's Wild Ride. So I emphasize again, it's a tough market. We have major earnings this week, lots of employment data, a Fed meeting, and a Powell speech. I don't think the markets are expecting a cut, but we'll be listening to comments about a potential cut in September. And like I said, it's not a 0% likelihood of a cut in on Wednesday. And if we did get one, I would wonder why and what are we missing. So I'm not expecting one. Again, daily market analysis at stocksanddocs.com, and now we're going to jump into the charting program. And now on to the charts. And I live down here in South Florida. Today was amazing, and I was out on my boat most of the day. And you can see the name of the boat and my website are the same. Actually turned out to be a pretty cool boat. I once saw the name Stocks and Blondes, and I thought that was the greatest name. But my wife's a brunette, and I have a really hard time explaining to her why my boat had blondes in it. So I went the next best, Stocks and Docs. On to the charts. All right, let's start with my weekly timing model. So those who know me, I follow this religiously. It gives me direction in the market. And right now, I've got long on the Russell, long on the diamonds, and a yield sign, but still long on the Qs, and a yield sign and still long on the spiders. There's two requirements. Price has to be above the 30 WMA, and the weekly bongo has to be green to turn on a buy signal. And in the S&P, that buy signal was turned on October 30th, November 6th, I guess would be the first week. Um, and it's been green ever since, despite the pullback in April. Um, and to reverse it, both have to occur. So just flipping the bongo as we did on the weekly this week on the spiders and Qs doesn't count until price breaks down. I look at this as still the dominant market direction is up, but I also look at a daily model, same exact model, and this one's not as good. The Qs, excuse me, the Russell, which is leading, is still in a buy, as is the diamonds. But on the daily model, we've got sell models on the spiders and the Qs. So how do I put that all together? I still consider this to be a pullback in an uptrend. Um, I am still participating in the market, but I'm not chasing big cap tech stocks that keep falling. And I'll look for a bottom because I think we're going to get an opportunity to buy them probably cheaper. I have not bought a lot of contra ETFs. I keep thinking about it, and then the next day the market rallies. So my main direction still says it's okay to be long, but when I see the danger on the daily and the yield signs on the weekly, it tells me small positions, tight stops, and don't be a hero to the long side right now. If we go and we look at the daily indices, let's just pull up the 5-minute spider. And so you could see I have the major indexes lines, and we just tell you what they are. The spider is the candles. And, it's interesting, Friday diverged again, where on Friday the spiders were up and came back some, as was the Qs. But up here, as you could see on Friday, the Russell gapped up and kept going higher after initial pullback. The mid caps gapped up, pulled back a little bit in the morning, and closed higher. The Qs didn't really have much of a move up at the open. The Dow, big move up at the open, finished higher. And so a bit of a divergence between the broader market and the narrower NASDAQ 100 and the spiders, cap-weighted spiders. I always find that to be interesting to see how the different indices are working together. Now, weeks ago, I wrote this, or 2 weeks ago, I said, yeah, we broke out of this box here. This was the low of the very bad day, July 11th, which was very similar to the very bad day that we had on July 24th. And I said, as long as we stay above this line, we're fine. If we break through, I expected us to retest, which we did, and travel down here, which is the gap from June 12th. And that's exactly what we did. Now, we broke through the 50, we held at the box or the rectangle, and we had a nice bounce on Friday. I'm not going to go big into this market to the long side until at least I break back above the highs before this market rolled over. We've come down about 5%, so we really haven't had a bad correction. But the spider was up Friday 1.12%. Just didn't get the big jump out of the gate that we saw on the small caps, mid caps, etc. So that is the spiders. The Qs. Here was the difficult day on 7/11. We broke through the low of that day. We broke through the 50. Um, Thinking that probably in this area here we get some support. But we had a bit of a rally up 1.03% with a doji indecision bar despite a big up move on Friday. Those two are the weaker. If we look at the diamonds, diamonds have really never broke. They had a pullback here, but still a higher low. And we'll see if it can get a higher high. Had a very strong day on Friday at 1.62%. And then the Russell, which has been the laggard but is catching up, um, had another nice session here on Friday with 1.65. Now, this tells me that it's setting up for potential divergence, but it hasn't broke down yet. So that's something that we will look at. That's not a trend line that I wrote. Um, it will turn red when it's confirmed. So we shall see. The Russell, the leader right now, was up an additional 1.65% on Friday. So diverging markets, strength in the Russell, diamond's not bad, but the Qs and the S&Ps considerably weaker. Take a look at the VIX. On the week, the VIX was down 0.79, but this is part of the wild ride. At one point, it was up 20% from where it is right now. We look at the dollar's consolidating in here, and on Friday the dollar was down 0.07%. Commodities, dollar down, so no shock to see the commodities head up. Let me just set this up while I'm talking. And you could see gold bounced off the 50 and was up 1%. Silver is not behaving nearly as well as gold and broke down. It was down on the session. It was up a little bit, 0.25%, but it's broken well below the 50. Oil has also broken below the 50, down over almost 2%. And the other thing that's good for the market, besides the dollar not going higher, is this consolidation down here in the 10-year, which was down 1.08% on Friday. I think weak dollar, weak 10-year, weak will be supportive of higher markets. This is just one day's look. Looking at the breadth, we can see that we're continuing to see big outperformance of the RSP equal weight S&P versus the SPY, and the QQQE equal weight Q versus the QQQ. For once, we can see that the Q is losing to the Russell. That was a long time since that happened, and that's something I like to watch as we go. From a hourly S&P sectors, this is one way I look to track what's leading of the industry groups. What am I looking for? Well, the strength, real estate looks really strong. You've got pointing up towards the upper right-hand corner. And these are all, ignoring this, that's Bitcoin. The rest of them are S&P sector ratio charts versus the spiders. So I'm looking for the things that are the highest up and the things that seem to be moving now. Materials is moving now. Financials and industrials moving now. And what really was working is biotech. Even healthcare turned up. What's not working now? Discretionary is weak, as is technology, as is communications. So it's all that market rotation. Now, next thing I'm going to look at, seasonality for a second. Um, I did a training the other day and I wanted to talk about this a little bit, but I didn't. So let's move this forward 1 week. There we go. And let's move this forward a week. All right, so if you look at major market ETFs, and I'm looking for any seasonality patterns over the next 4 weeks. And it says here that seasonality is not bad. However, if you look at the Qs, the seasonality, yeah, for the next couple of bars is supposed to go up and then we roll over. Maybe we're rolling over early. We look at the spiders, similar pattern, expecting a late summer, August, September pullback in the market. And then the same thing on the Russells. So when I see this pattern, it tempers me again from wanting to be a hero and going all out on this market. So let's go to my stock scanners. We'll start with the heat map at the NASDAQ 100. You could see a lot of strength on Friday. So let's look at some of the big boys. NVIDIA has broken down below the 50. Um, is it dead yet? No. God forbid it goes down to the 200. That would kill this market, which is at 77 now. But right now, would I be buying NVIDIA here? No, I'd be looking for it to run into the 50 and find an opportunity to short it. Tesla, broken below the 17, holding at the 50. This is an old trend line that it's holding at, which is interesting. Probably a pretty important decision point, also well off its highs. Microsoft has broken below the 50, had a strong day on Friday, up 1.64%. Apple, earnings this week, broken down below the 17th. Is it going to do like the rest and visit the 50? Google, that's a nice candle with a big bottoming tail, but boy, falling knife below its 50. AMD has broken below its 200, so it's ignored all the opportunities for support. Meta broke below the 50. Is it trying to do something here? Was up 2.7% on Friday. We'll see. And CrowdStrike never really has given us the bounce after its shutting down the world's Microsoft computer moment um, a week ago. So even though there's a lot of green on Friday at Big Cap Tech, they don't look so good, do they? I think that's an important sign. Um, of course, earnings can change that. If we look at um, S&P 500, probably will look very similar because it's dominated by big cap tech. Um, Boy, I hope you don't own any Dexicom. Dexicom, and this was where it was before, Dexicom just died on Friday. And I think there was an earnings, and it's interesting. On paper, it had an earnings win. Now, I just know the stock died. I don't know if this is the impact of the GLP-1s reducing the need for the aggressive treatments for diabetes or what it is, but I would just say that that's a pretty impressive move. Ouch. And then the Russell 2000, just for comparison's sake, the small caps, a lot of green. All right, so looked at those parts of the market. Let's go look at Wealth Scanner to give me a sense of what's leading. Now, Thursday night, I was shocked at how weak these ETFs have fallen over the prior week. But you could see we've now got things back above 800. Still go down to the mid 70s to finish off. It's weaker than it was a couple weeks ago, but there's nothing wrong. Now, what's leading? Pharma, genomics, dividend payers, regional banks, dividend payers, banks. Aerospace and defense had a great week. Home builders, small caps. Isn't that interesting? Russell 2000 value. Insurance, construction, Russell, dividends, biotech, high yield, healthcare, capital markets, biotech, biotech, USA value, financials, dividend growth, and healthcare. Not one, communications, energy, technology, index, ETF, theme, group, sector, industry among them. So we have a relatively narrow leadership. Now, I like buying pullbacks. All right. I don't like buying things that are extended. So I'm going to look at my CAT scanner and see if we can't find any picks. And we're going to look at, well, let's look at my combo leaders list, which is a curated list of stocks that I put together every week. For Wealth Charts users, the code will be in the remarks section. It's somewhere, and then let's rank by 4 dots. So this is specifically to identify stocks that have recently stubbed their toes, but turned around, are in an uptrend, and it's requiring one of my signal dots. Baker Hughes Energy. Um, Not in it, but looks pretty good, except it's getting a little bit extended. But I'm going to give it a pass, even though the high low is 100. Why? Because the 70 and the 50 have just crossed over the 200. And I think the fact that this thing's been so flat for a period of time is going to make the high low less useful. Um, Had a gap up on Friday on great volume, breakout momentum dops. You can see this red turn to green. This is the daily bongo. This here is the weekly bongo. And this red turn to green, that's the stubbing the toe. Relative strength versus the spider is high. OBV is good. So Baker Hughes looks interesting. Charter. This one moves a lot, especially in market turbulence. Strong market, had a big gap up, had earnings 849 versus 798, so a nice 6.5% surprise. That explains it. Um, Again, I would ignore the extension looking at the pattern of the um, moving averages. I look for extension in a long uptrend or downtrend, not something that just changed directions. Relative strength and OBV look good. Um, Colgate Palmolive, boring company, but look at this beautiful move up. You had a gap, volume, breakout momentum from a squeeze, not too extended, great relative strength in OBV. I mean, boring, boring, boring consumer staples, but I like it. CNC, Centene, United had some great numbers and a great move. So Centene had earnings on Friday. They had a 16% beat. And let's see what United did after their earnings. You could see the earnings were here. And even though they closed lower than the open, they were still up on the session. And the market continued to go higher. So CNC might have some room to go. EVRI, I think, had a takeout offer this week. So forget that. I think Apollo's buying that. One of my favorite stocks is FTAI Aviation. What a great move. Now, how could this not be extended? Because it's not going up at a 90-degree angle. It's a nice 45-degree ascent, 86% on the high jump, great relative strength in OBV. Broke out, had great earnings if I remember correctly, 165% beat. Wow, one of the leaders right now. IGT was also a buyout on Friday. See if anything here were things. Now, I'm sort of surprised that CVS has made it so high on the list because CVS has been beaten up. But you have big volume, breakout momentum, flip the bongo, relative strength in OBV looks good. Now, I don't typically like to buy stocks below the 200, but that's kind of interesting looking as well. As you could see, quite a few stocks here on the list with 4s and 3s. I did put together a list of stocks that was pretty ridiculously long that I'm going to be watching, not, that I thought were interesting candidates. So let's see which ones here I would want to show you. Bristol Myers had a huge move on earnings. You look at this, where it had a 27% beat, stock that's been in a downtrend, pays a dividend, and you compare this to LLY. And thinking about the rotation we're seeing, are we going to see some of the other pharma, remember that was the top leaded group, starting to move up, and Lilly and NVO move down? Or don't know. Assured Guarantee is just one of the many insurers on the list. You could see it pull back and now moving higher. Earnings are coming, relative strength and OBB look good. KIE, I believe, is the insurance ETF, and this thing had a big run, consolidation, and running again. So there's a lot of insurance companies on this. Here's AJ Gallagher. That's a pretty impressive candle. If you think about it, it means the market thought their earnings were bad and opened lower, and then realized not so bad and changed much higher. A belt hold candle. That's a pretty substantial candle. And their earnings really came in as predicted. But that's a beautiful, nice uptrend, great volume, three dots, relative strength and OBV. And again, I'm not going to consider it overly extended just looking at the chart. What else do I want to see? Cincinnati Financials, another big belt hold, probably an earnings response. This one had a 34% beat on earnings. That's the challenge or the opportunity with earnings season is you'll see a lot of things breaking out, and will they follow through or not? This is GE, past uptrend, broke down here, consolidated, looks like it's breaking out here. Decent volume, breakup momentum from a squeeze, not extended. And the earnings were here, and the earnings were pretty good, a 22% beat. Hasbro, I got a granddaughter, so I'm spending a lot more time in toys than I was before, and a grandson, can't forget him. Just she's older, and she lives 5 minutes away. Um, Hasbro had a interesting reversal of fortune. Earnings were great, a 56% beat. Big gap open, closed at the lower of the bar, still up significantly on the session, and had great follow through on Friday. That might be one to look at. McKesson, I've sold companies to Amerisource, now called Cencora, I've sold them to Cardinal, have not sold it to McKesson. This one is just a monster stock, an operating machine, and what a lower left, upper right. It just looks like it wants to go again, something that I'll be watching closely. ServiceNow sold off because first they said Google was going to buy it, then they're not going to buy it, but it turns out they can do a lot with AI. 10% beat. The street loved their story. You can see a big move up and held close to the prior close on Friday. Also in the payer space, very similar to Centene, a lot of Medicaid business, was Molina. Again, I wouldn't be doing much with it below the 200 except watching it to break above the 200. One that's been a nice player, a nice move over some time, is an Indian travel company called Make My Trip. I've been in and out of this stock. What a beautiful uptrend. It's the kind I wish I would have just stayed in. Earnings are out, and you could see they had a 39% beat. That looked pretty good. The home builders all look like this. This is Pulte. They all had a big move up on earnings. You could see Pulte had a 9% meet, likely go up if and can raise their prices if rates get cut, and I think that's why there's strength there. I think ITB might be their ETF. Told you same exact pattern. And then let's see, RELX. It's an ETF, so it's kind of jumpy here. Pullback and a breakout. Look at that weekly chart. This is a monster. and you look at its earnings, uh, don't know because we don't have a projection, so I can't say that beat. Ryan Specialty Holdings, another beautiful uptrend. So there are a lot of really good looking stocks. Um, I don't know if there's a lot of really good stocks saying buy me right now, right here. Here's um, WR Berkeley. This one had been a monster leader, pullback, but nice consolidation here. Consolidating really going back to April, and then had an attempted breakout here that failed. Had a nice move on Friday. Earnings are out and 13% beat. Flip the bongo, relative strength and OBV look good. This is another one that's worth watching. So I don't think I showed you anything that's the obvious buy because the market's just not that market right now. But there are a lot of things that look interesting, a lot of things that I'll be watching closely. I hope you have a great week, and I'll look forward to seeing you next week. Trade safe.